For the next session, the topic is Wealth Management, the Road Ahead. From a global perspective, we now turn to the Indian perspective on the trends and the business of wealth management in India. And for that, I would like to invite Mr. Gaurav Kaushik. Gaurav currently serves as the Executive Director at Avendus Wealth Management. He has 2 decades of experience in wealth management in India. Previously, he had a very successful 18-year stint at Kotak Wealth Management, which is now Kotak Private Wealth, working in various roles in family office advisory and client relations. He has been an active member of the CFA Society since 2012 and is currently serves as the co-chair of the Delhi chapter. He completed his graduation from SSCBS in Delhi University and attained his CFA charter in 2011. Gaurav, please take it over.
Thank you for the kind introduction, Achal. It's turning out to be a great day of learning. We've just concluded an interesting session on global wealth management with Daniel and Shamit, and now we move our attention towards wealth management in India. It's my privilege to introduce you to our next distinguished speaker, Mr. Umang Papneja. Umang is the CEO at Julius Baer in India. It's one of the oldest and most reputed wealth management firms. Julius Baer is now in India for over a decade, but I must tell you that its business and the team that he is heading is over 2.5 decades old. It was earlier known as DSP Merrill Lynch, which was taken over by Bank of America, and then Julius Baer. In his current role, Umang is responsible for driving the India growth strategy and responsible to steer the firm's local product and infrastructure innovation, catering to the growing community of high net worth individuals in India. In September 2009, he joined IFL Wealth, which is now 360 ONE, where he was instrumental in providing strategic guidance for investment decisions across asset classes, including equity, real estate, fixed income, commodities, and alternates. And I can tell you that IFL Wealth has been at the forefront of product innovation in India, and a lot of that credit goes to Umang, who's been the core pillar and brain behind that. In September 2005, he joined Society General Private Banking in Mumbai as director and head for investment advisory, and successfully created investment products and ideas for domestic and NRI clients of the global Indian subcontinent. He's a postgraduate in management studies from Jamnalal Institute of Management Studies, and he's also completed an executive program from Singularity University in California, US. With that, I request Umang to please come up and share his thoughts and knowledge with us. I'll also request the audience to punch in their questions in the app, and we'll take them up at the end of the session. Over to Umang.
Thank you, Gaurav. I hope I'm audible at the back. And it's my privilege to be coming at this stage and talking to all of you at the CFA Society. And thanks a lot, Srinivas specifically, and the whole CFA Society for inviting me and letting me talk about this topic about the future of wealth manager. And when I was hearing Gaurav and when he was introducing me, it seems that it's been quite a while that I've been in this industry. And yes, he's right. I've been working for the last, this is my 25th year. I started around when the century was starting, so it was around the year 2000 that I started my career. This is the 25th year in the financial services market. And when I look back at what wealth management industry was and now, we've come a long way. Just to give you a perspective, and when I started my career, the GDP of India was $400 billion. Today it's $4 trillion. So we've been lucky as a generation at least, or I've been lucky, many of you are younger here, but I've been lucky to see this absolute 10x growth in GDP terms, which many generations do not see, specifically in the developed world. And hopefully I will also live to see the next 10x as India reaches a $40 trillion economy. But interesting is when you look at assets under management, when around the year 2000, mutual fund assets, because that's the most available data at that point, was at 75,000 crores. Today it is, all of us know it's more than 60 lakh crores. So it's been a huge huge exponential growth which we have seen in assets under management. And it also reminds me, I just met a client last week, and he was sharing his portfolio. There was one investment in his portfolio which he had done in the year 2004 in one of the local, very prominent fund houses, one of the schemes which has been loved for many years and decades. Just to put the exact statistic, he had invested 32 lakhs in 2004, which is today 20 crores. You would have heard of many examples of our schemes. Many of these schemes have given these kind of stellar returns over the 20 years. But what's interesting when you look at this data point is that 20 crores today, that fund's total expense ratio is around 1.6%, because it's a large scheme. It's approximately 60,000 crores of assets under management, that particular scheme. And 20 crores, 1.6% is 32 lakhs, which exactly was his initial investment amount. So today he's paying an expense ratio of something which was equal to what he invested 20 years ago. So that's something which is really phenomenal to see. Now, before I go into some trends of wealth management and what I see in the future, just wanted to talk about maybe scope out the revenue. Everybody keeps coming and talking about number of HNIs and the AUM. Let me just make it a little twist here and try to scope out the revenues of wealth management industry in India at the moment. So let's start with the data which is very easily available, which is the commissions earned by mutual fund distributors. So this year, the number came out to be, all of you must have got those WhatsApps, who's got how much commission last year. So if you combine all of that, the mutual fund distribution community has earned 15,000 crores last year. Now, and when I'm talking about wealth management, I'm talking about two lines of business. One is, of course, distribution revenues, and second is transaction revenues, which is largely brokerage. So that's how I'm going to scope out the revenue pool for the wealth management industry. So now coming back to our assessment. So first is 15,000 crores. That's the revenue pot. Second, there's the retail equity brokerage and transactions, which all of us do. Last year, that number was close to 30,000 crores. So that makes it 30 plus 15, that's 45,000 crores. We have AIF and PMSs, which also give us revenue in terms of the wealth management industry. So all put together, so AIFs, the drawn down amounts of the amount committed is around 3 lakh crores today. And PMS is another 3 lakh crores. So that gives you another pool of 5,000 crores. And maybe if you add also lending and MTF, which a lot of brokers do, that book is around 1 lakh crores. So maybe generally lenders make 2% average spread. So that's another 2,000 crores. So when you add up all of this, the number comes to around 55 to 60,000 crores. So which we are talking about a $7 billion revenue number for the industry at the moment. Now, if I want to extrapolate and go a little ahead to 2034, let's imagine that we are in 2034 right now, and you know how much new money is coming into the system every year. So if you look at a 15% CAGR, now I'll tell you how I came at this 15% CAGR. Numbers can be different, can be higher, can be lower, but it's largely around 8 to 9% mark to market, because there will be the industry has a mix of equity as well as fixed income. Equities could do 12%, fixed income could do 7%. So average, I think, portfolio should go up 8 to 9%. And new money to the system is around 6 to 7%, which we are seeing every year. So if you do this CAGR and just multiply that number, comes to around 250,000 crores by 2034. So that's the kind of scale which we are going to see in the wealth management industry in the next decade or so. There could be some pricing pressures, etc. So maybe you can safely assume the industry number from a revenue perspective to be 2 lakh crores. Now, when you're in an industry, and I'm sure many of you are students also thinking about your careers, and maybe many will watch this video later, the industry size, any industry size going from 55, 60,000 crores to 2 lakh crores, definitely an industry which will need a lot of people in the future. So it's very important to see what kind of challenges we as an industry are going to face over the next decade or so, or even more. I've not gone beyond a decade, the numbers get better and better, but let's stick till 2034 estimates as of now. Today, when I look at, and I think there is a session later, and one of my friends, Naveen, is speaking about it, it's about talent acquisition and retention. I think you've got the best speaker to talk on that subject. But when you're looking at the pool, say for example, just look at the relationship manager pool in the wealth management industry. We are all of 1,000 RMs. And if you're talking about an exponential growth in this industry, we need to train and induct more relationship managers to start with. Of course, there are many other aspects in wealth management, but let's just focus on the RM side at the moment. 1,000 RMs can't be managing this industry. So we have an acute crunch of talent, and which I think all of us as an industry should come in now and start training people. So that, I think, would be one of the biggest challenges which we'll face as we scale up in the industry. Second, of course, is technology. I think Daniel also was mentioning I think globally technology is changing. But a special mention on our wealth management industry, I think when I look at other financial services companies or sectors, vis-a-vis wealth management, I think wealth management is lagging a little behind in terms of technological innovation. The innovation's been much, much more as far as the other industries or other parts of financial services are concerned. Many of us still use legacy systems, whereas we are, of course, feeling the heat from new wealth tech, and the old incumbents will have to kind of innovate and get up the technology curve. AI will be big in the future. So second, of course, technology becomes a big part. Third is learning and development. Now, when I talk about learning and development, Daniel did mention the intergenerational shift of wealth, which is going to happen globally. He mentioned $70 trillion worldwide, and India also will, probably there will be an intergenerational shift of at least $1 trillion to the next generation. Of course, we've seen campaigns like Mutual Fund Sahi Hai and things like that, but I think there's a lot to be done from our side, from the wealth management side. The mutual fund industry is doing its bit, but I think from our side it's going to be much, much more work required to kind of educate people going forward as the new generation takes on the wealth. Secondly, on a learning and development perspective, even for new talent which comes in, it will require a mammoth task. So I think most of us will have to significantly invest into this area. So that was my first trend, so which is scale. I mean, scale, we are looking at 55,000 to 2 lakh crores. What is scale going to get us? These are the challenges which we'll have to face. So that was my first trend. Let me now talk about the second trend. I call it geography, geographical breadth. Now, again, let me go back to the year 99-2000 when I started. At that time, wealth management was only 2 cities. It was Mumbai and Delhi. Right? And of course, we had a few clients here and there. Today, it's completely different. Now, let me give you an example how things are changing. So at the same time, when I started my career, there was an industry which was starting to boom, which was the information technology industry. In the late 90s, it reached $1 billion of revenue. And people were skeptical, how big this industry will become. IT industry, there were many skeptics, as always. People spoke about this is a Y2K boom. After the year 2000, these programmers will not be required and things like that. I'm not sure whether many of you were around at that time. And there was a huge skepticism about the future. Today, when we look at this industry, it is more than a $200 billion industry. So 1 billion from the late 90s has gone to $200 billion. Now that's, of course, you've seen that. Now let's now again go a little forward back to forward ahead to 2034. And let's put a, very low CAGR number of growth. Say, let's assume that we put a 7% number for the IT industry growth. I think it's going to be much better, but let's for easy maths, let's do that. So by 2034, you're talking about, an industry which probably will go up to maybe double the size, so 200 billion goes to around 400 billion. Now, when you just do the math of cumulative turnover of the IT industry over the next 10 years, it's going to be $3 trillion. So 200 this year, going to say maybe 220, then 240, so on and so forth. And if you add all of this for the next 10 years, it's going to be 3 trillion. Now, the interesting part here is 50% of the top line in IT services is employee cost. Right? So if the cumulative turnover is going to be $3 trillion over the next 10 years, IT industry salaries cumulatively are going to be $1.5 trillion. I mean, that's the kind of money which you're going to see in only one sector. So, and are they in Mumbai and Delhi? I don't see many of the IT industry guys in Mumbai and Delhi at all. So it's going to be across, of course, Bangalore and Hyderabad, but it's going to be in Indore, it's going to be in Pune, it's going to be in Jaipur, Chandigarh, things like that. So it's going to be hugely diversified in terms of pockets of wealth. So I just looked at a professional segment right now, but when you look at the startup scene, it's completely different. We are a country of 90,000 startups, and market cap is expected to be more than $500 billion in terms of startups in 2034 alone. And that kind of money which comes in, this innovation is not happening. We've got Rajesh here listening to me, but that things are not happening in Mumbai, maybe to some extent Delhi, but it's happening across the country. So my second theme was largely geographical breadth, and when we look at our challenges for scale, the lookout for talent, it's not only going to be in the metro cities, it's going to be across India. That's the second one. Let me now talk about one more trend which we are seeing. Now, I was lucky enough in around 2018 and 19 to work with ma'am at SEBI on the advisory regulations, and that came out in the year 2019 and early 20. And there it was clear from our committee which worked on it. We basically said that either the client pays you or the mutual fund house or the manufacturer pays you. So it's either or, right? It was never that clear before. And that regulation came about as we approached COVID. Now, when you look at from there and now, every product or every investment which you do has a direct plan. It was not earlier, only mutual funds used to have a direct plan. So for an advisor to take a hat of only getting paid from the client, it was not logically possible because none of the other instruments had any direct plan. But today, all of them have. And the foundation has been laid for this explosion of advisory business. Today, it's a little funny that there are more AIF manager registrations than the number of advisors in India. So which is little ironical, but I think that number of registered investment advisors and people moving towards advisory business is going to explode. So we are going to see many of us in the wealth management industry sitting on the side of the client, giving asset allocation, right asset allocation advice, getting you the right instruments, and taking money from the client instead of the producer or the manufacturer. So that's a dramatic shift which we are seeing. At the moment when I estimated the wealth management revenues, I did not ascribe any revenue to this because there's hardly, it's negligible revenue pool at the moment, but it's going to get larger and larger as time progresses. Right? So that's the third theme. Now, let me speak about savings and equities as an emerging asset class and how equities are going to come back into the forefront. Right? So let's first talk about savings a little bit. So India is saving around 17 odd, 18 odd, 16 to 18% of GDP every year. So when you look at the numbers, and of course these numbers are rising every year, so we've got approximately $700 billion of savings every year as Indians, which we do. Just to put you in perspective, US saving rates have collapsed to 3 odd percent. It used to be a longer term average is around 8%. So the Americans are saving around $1 trillion, Indians are saving around $700 billion. So that's the kind of size and scale which we are getting into. Now, out of this $700 billion, around 50% of that goes in physical assets. It's reducing. It used to be earlier higher. It's right now 50%, might actually go down further. But let's look at the current stats and let's try and estimate what's going on here. So 50% of that, which is around $350 billion, goes into physical assets. $150 billion of that goes into fixed deposits. So that's $500 billion has gone out. So that leaves around $200 billion for financial assets, whether it is mutual funds, direct stocks, bonds, so on and so forth. Right? Now, of course, the mutual fund industry is doing a great job in attracting a lot of that $200 billion, and this pie is, of course, rising as GDP increases. But there are two things which we need to see, and why I think in this $200 billion, equities will become a larger part in terms of allocation in the next decade. There are two things which I think is driving it. One is the initiatives, of course, which the government has taken on Make in India, and of course the exports rising. Now let me spend some time on that. Now, current account deficit for India is now, right from being a fragile 5 in 2013, where current account deficit was around 5% or so, we've dropped down to around 1% or so. So if you do that number on a $4 trillion number, we're talking about a 40 billion number. So in terms of absolute amount, our current account deficit is around 40 to 50, depending, it's 1.1, 1.2, 1.3. I mean, it's in that region. So we are basically doing a 40 to 50 billion dollar current account deficit. Now let's look at the Make in India initiative, and I'll give you only one example. Apple manufacturing, or Apple iPhones, which all of us understand and use, last month announced that they did $1 billion of sales in 1 month, so which is an annualized run rate of around $12 billion. Right? Now, Apple's come on record saying that within the next 4 to 5 years, this number can be as high as $75 billion. Right? Just now start putting in perspective. Of course, the whole $75 billion is not a net exports number. There would be something which they would have imported. But just to give you a perspective, $75 billion of only one initiative in the Make in India, and current account deficit of 40 to 50 billion dollars, right? So I'm very clear in my mind that India is going the current account surplus way. So in a few years, India will be a current account surplus economy, and that, believe me, does wonders in terms of perception of the Indian equity markets. Of course, all of us are hearing that FIs are the most underweight at this moment. Things will completely change when India becomes a current account surplus economy. Now, it also gives stability to the currency and many other aspects, right? So that's point number one, and why equities will be forefront of that $200 billion allocation. Second, I think an unintended consequence, I think, is the taxation. There was a change in taxation for fixed income mutual funds, and since then we have seen that inflows in mutual funds is largely equity oriented and not fixed income oriented at all. And people have realized that if you make 7% in fixed income and pay 30 to 40% tax, depending on tax bracket, you're just making 4% on a net basis. then nobody's interested anymore, right? So we are seeing a huge movement towards equity as a culture. And that's happening both on equity broking side. Of course, there are some excesses in future and options, which the regulator, I'm sure, will take care of. But from a SIP standpoint, a disciplined standpoint, I think that's really moving in the right direction. So I think when we look at building a platform from a wealth management industry for the next decade or so, if we are not concentrating on equity and an equity culture, I think we are going to miss that bus. So that, I think, was my fourth trend. And maybe, maybe as a last point before Gaurav comes on stage, I'll just spend some time on the platform. Now, from a platform perspective, what we are seeing is, now we discussed equity, we discussed distribution, we discussed transaction revenues. So there's so many startups coming in and existing players as well, trying to capture this 2 lakh crore revenue pool. I think platform will become key, whether you're doing wealth management for the mass affluent or super HNI or the HNI segment, whatever segment you are in, platform will become extremely important. And if it's just not going to be only about giving a transaction transaction platform or a distribution platform, it's going to be much more than that, like succession planning when we discussed this transition of wealth from one generation to another, or even looking at sometimes offshore advice or investing offshore. We've got so many funds here, and then there's the LRS and so on and so forth. So whenever we're building a platform, I think completely encompassing platform will be the need of the hour. And many of my competitors, and also including Julius Baer, we're trying to build everything which is there as far as the platform is concerned, whether it's digital or physical, and things like that. So this was basically a few trends which I wanted to highlight about, and I would call upon Gaurav for maybe a Q&A if you have any questions for me. Thank you so much.
Thank you so much, Umang, for sharing all your thoughts. In fact, I was speaking to an ex-colleague of yours preparing for this event, and he talked about the clarity of thought and the brevity and the depth of knowledge that you own. And a lot of that aspects came in quite clearly in the way you spoke today. I'll request the audience, while we are getting questions, to keep typing their questions. And in the interest of time, we've just cut down on the session time here. I'll start with some of the things that I had in mind. In your Umang previous assignment, you had worked with some of the largest UHNIs family offices in India. And in the current organization, you have now the added advantage of working with some of the global Indians. So how do you see the behavioral aspects of these two sets changing over the years?
So while answering, I'll just not look at only global Indians. I'll talk about the international fraternity as a whole. I think it's both the fraternities, I would say both the fraternities have become much more patient. Okay, so my experience earlier, when, say, for example, you used to go and travel and talk to investors, there was always some spots where India used to become a very favorite asset class, and they used to come in. Most likely it used to be a euphoric time, and they would all go out disappointed. So they would always sell at the wrong time, and the experience of Indian investing wasn't so great. But when you look at numbers, and had you stayed back when I give you the returns, either the GDP going up 10x or returns of a particular fund going up 70x in 20 years, I don't think people really experienced it. So it's just that people did not, they did bits and pieces, came in, probably invested for 2-3 years, went back, came back after a few years, things like that. I think that has changed on both the sides. So even locally as well as internationally. So I think that's the biggest change. People are ready to wait it out. People have understood the compounding story which India is, and that's the biggest change as far as investing patterns and behavior is concerned.
Great. And one of the challenges for advisors like us is that as markets tends to do well, you get far more money, in assets and advisory and various investment products.
Yeah.
So how are you currently facing and handling that challenge?
So is it a good thing or a bad thing? In what
I mean,
sense
for the advisors,
Yeah.
it's always the challenge that.
Yes, of course. So, so I think it also depends. So right now, so for instance, there are a lot of things which one can argue might be in a euphoric zone, right? I think that's what you're referring to. And then once you get money when many of the sectors are in a euphoric zone, what do you do, right? So A, of course, asset allocation comes in, but B, I think in any equity market, when equity becomes your mainstay, there are sectors which trade at a significant valuation discount than other sectors, right? So for example, when I look at current markets, one can argue that small and mid caps might be extremely expensive or maybe are going in the extreme expensive zone. But when you look at the financial services and banking sector, it's when you look at the price to book values over the last 3 to 4 years, it's the lowest. So you will always find some spots in the financial markets which will be significantly cheaper than what they should be. And that's when I think you can do some over allocation and kind of protect and do the right thing. So maybe I'm saying it's a little bit of a contra approach, but that's what you always get a chance to do.
Great. So actually, role of the advisor becomes even more important
Yeah.
to guide the investors properly in such kind of
course,
times.
of course.
Next question, I would want to ask you about the role of technology. You talked about the industry at least lagging as far as the UHNI market is concerned.
Yeah.
But we have the other end, which is now getting catered by fintechs, where technology is not just a support but more of an enabler of business. So how do you see this shaping up going forward?
No, it's a very, very good question. So if you go back maybe a couple of years, so maybe somewhere around 2022, you suddenly had an emergence of a lot of wealth tech players. And what happens there is, so say for instance, that all of your data is available to CAMS, and all of us get a monthly statement by the month end, so which means data is clearly available. So, but if you build something on top of it, so I'm just giving you an example of technology, and then I'll go to that. But you build something on it, saying that okay, this is my PAN number, this is my phone number. You get an OTP, you put your OTP, and the advisor and the wealth tech player gets the whole data out of all mutual funds and equity stocks wherever you have it. It's not necessary that it needs to be with him. Once you get that data, you can crunch, you can make a presentation, you can do an advice, you can run AI and create a auto presentation, things like that. So that was for some time available only to wealth tech, and conventional players were grappling what is this that has hit them. Now, but every time, there are players which come in, there is a little bit of a lead for wealth tech players, but there are always B2B players which come in, offering the same solution. So they're not interested in running wealth management, but they're interested in offering services and this AI capabilities as a B2B player. And then that gives us an opportunity for the older players to come in and subscribe and not build it, or just buy those things and play that catch-up. The other option, of course, is to build IT yourself. But honestly, from a conventional mindset, it's easier to buy than build. So that I see that gap narrowing very quickly, although there might be some wealth techs ahead in technology, but that gap is going to narrow very quickly.
Correct. And Umang, we've all known you for your prowess on the product side. Alternates is no longer like a a small allocation. It's reached a decent size as far as the size of the market is concerned. So on the product innovation side, where do you see things moving forward?
Sure. So first of all, let me just address that question about alternates, and let me take you a little bit into history. So now mutual funds, of course, all of us know that started in 1964 when UTI was formed, and most of the private sectors came in the 90s. And whether, it depends on how much you want to see, whether it's a 30, 40-year history or whether it's a 60-year history. Mutual funds have come up to approximately 750 to 800 billion dollars of size. When you look at AIFs, which came in 2013 and 14, they're already at 100 billion. So it's been an exponential rise from 0 to 100 billion in just one decade. So of course it's amazing that there has been a potential huge explosion in terms of AIF as a category and alternates as a category. But when I now go and look at portfolios of clients, suddenly, so which means a large part of the incremental money has gone to alternates, the allocation to alternates has become much larger than probably what people wanted it to be, right? So there is a possibility, Gaurav, that maybe mutual fund growth might really pick up more than alternates growth for some time, till allocations rationalize. But having said that, AIFs is clearly an innovation platform, and that innovation will continue on the AIF side for years to come.
Sure. There are two questions from the audience, one from Rishikesh and another similar one from Kapil. And they are talking about, while we all are very optimistic about how things are shaping up in India, but they want to know about the risks associated with the wealth management industry related to regulatory risk and things like that.
So, okay, I don't know whether we should call it risks, but will regulations keep changing? The answer is yes. Will players adapt to it? Yes, they will also adapt to it. So what normally happens is, so if there are certain excesses in certain areas of the market, the regulator steps in and plugs that, which is very, very the absolute right thing to do. And the industry really adapts to it quickly and goes on. I don't think it's a risk. It's maybe an adaptation time, which might be longer for some and shorter for some, but everybody does adapt. So I wouldn't call it a risk, but it's a change. So there will there be changes? Yes, there will be changes. There's obviously no doubt about it.
Sure. So last question, we are running out of time. You talked about the talent crunch and just about 1,000 RMs being there. So, and a lot of our CFA audience, younger crowd who've completed their charters, and also the existing incumbents in the industry. So how do you see the two sets of individuals? How can the existing guys upskill themselves to continue to remain relevant? And the newer guys who are seeing the growth of the industry over the next upcoming decades, how can they join this this whole industry, and what are the roles available for them?
Sure. So so first choice, whenever you're choosing which industry to work for and you're going to spend 20, 25 years or maybe even more in that industry, it's very important that you choose a scalable industry, whether it's going to scale up from X to say 5X, 10X or whatever it is. Right? The answer for wealth management industry is yes, it is a scalable industry. So at least the first tick is there. It's going to require people all the time. And you don't want to be in an industry which is growing or which is just not about growing or declining, and then it becomes an issue from a career perspective 10 years later, and then you realize you can't do anything else, right? So the first tick is there, that it's a much, much more scalable industry, and I also spoke about the revenue possibilities and the revenue pool possibilities over the next decade or so. So the answer to that question is yes, it's a great industry, it's going to scale up. Now what do we do? So we need to start early, and CFAs I think are the best equipped from a knowledge perspective to handle wealth management, because the program that way is structured in in a direction which normally what wealth management industry would require. And besides CFAs, I'm sure MBAs and CAs also can come in, so that, talent pool which is there needs to be built from these three, aspects. And it's not only relationship managers, Gaurav. It could be, say, on the product side, it could be an investment research analyst, could be a mutual fund research analyst, could be a structured product desk person, could be somebody in operations, could be a compliance person. I mean, there are certain, lots of career opportunities which open. So if you're a lawyer by profession, this industry would need legal people as well, so on and so forth, right? So I think the opportunities for employment in this industry are going to go up manifold. We are already seeing signs of crunch across, and I think it's only if we don't start early with talent grooming, I think it's only going to get worse. Worse in the sense good for the employees and worse for the employer. Yeah.
Correct. We all are aware of those challenges.
Yeah.
So thank you very much. It was a great session. We have to unfortunately wind it up a little early. But Umang is around during the break. Please catch him for networking or any other question which may have got missed. Thank you again so much for the session, Umang.
Thanks a lot, Umang and Gaurav. A round of applause, please, once again. I would love to invite Jana Gandhi, our director at the CFA Society, to give a token of appreciation.